everyone. Welcome back to Policy and Profits. I'm Anthony Esposito of Ascalon 6 Capital, joined by EJ Antoni, Chief Economist at the Heritage Foundation. EJ, how are you today?
Anthony, I'm hanging in. Yet another crazy week, but I like to think I'm getting a little closer to that winning at life, that you always seem to be doing, my man. So how about you? Are we still on the winning at life track?
I am winning at life. I have all the important things: a wonderful wife, wonderful family, fantastic children. Everything else is kind of a bonus if I can get to it, but definitely winning at life. Frustrated with life, but winning at life. Not as frustrated as President Trump is with Jay Powell, as we all know. Little visit to the Treasury renovation site yesterday, which was classic Trump, kind of slapping him on the back and asking him for a cut in rates. We've been through a lot of different iterations of why he's done such a bad job, and you have really led the charge. And quite honestly, you've educated me a ton on how the Fed works, how remittance payments work, where the Fed is actually losing money, making money, what monetary policy means, balance sheet management. You've done a wonderful job of it, and I think this episode we would do a service to kind of look at some of the charts you've posted and look at exactly what's going on there. So, as a quick intro, Jay Powell's politicized and inept. We'll just stop that there.
Yeah, I'd say that's fair.
We're talking about losing $100 billion plus a year now at the Fed, the elimination of remittance payments to the Treasury, which is creating a deficit issue and further burdening the taxpayer. These are your words, not mine. I'm regurgitating what you've said to me. The first graphic that we have up are the daily interest payments made on the reverse repos. So the Fed is losing money on the imbalance of what they're receiving on assets and what they're paying out on liabilities. And part of it is the interest they're paying on these reverse repos, right?
Yeah, exactly. And this chart, I think, is part of the reason, Anthony, why as much as the 2.5 billion in renovations is a scandal, it's not that big of a deal compared to some of Powell's other mistakes, right? So what you see here in the chart is the interest costs to the Fed, the daily interest costs on those reverse repo operations, but also from the interest on reserve policy. So you can see the interest on reserve is larger here, especially now that the balance sheet runoff, the reverse repo operations have really shrunk. But you can see it's still hasn't gone away. So, but between those two, you're paying almost $500 million a day in interest. I mean, that's obscene. And you're right. What has happened with the mismatch between assets and liabilities at the Fed is exactly the same thing that happened for a lot of regional banks, which started that regional bank crisis in the spring of 23, I believe. And it was Silicon Valley Bank that really caught a lot of headlines. So we had the second largest bank failure ever because of these crazy interest rate changes that Powell has presided over. So for the Fed, things like interest on reserves and reverse and interest from reverse repos, those are just whatever the current rate is. In other words, as rates go up and down, the Fed is paying those daily. So it's whatever the daily rate is. But if you look at the other side of the Fed's balance sheet, not the liability side, but the asset side, the Fed is loaded up with a lot of Treasury bonds, with a lot of mortgage-backed securities. Right. So you're looking at mortgage bonds there as well. That means that you have locked in a lot of interest rates, and they were locked in when rates were like 3%. So the Fed is paying 4.25%, 4.4%, depending on what we're talking about here, interest going out the door, and they're only getting 3% interest coming in on a lot of their assets.
Yeah.
So again, it's that interest rate mismatch that you identified that is costing the Fed all of that money. And the really scary thing, in my opinion, is a lot of that money isn't even staying here at home. It's going to foreigners.
So that's a good point. Let's bring up the reverse repo agreements, because in this chart, I think you're including foreign and international accounts with how much there is actually outstanding at the Fed. Is that correct? Is this kind of playing into or pulling in those foreign really accounts payable for the Fed. So they're sending money out based on these reverse repo agreements, but they're not all with domestic U.S. banks.
Yeah, in fact, Anthony, about 2/3 of the payments from reverse repo operations go to foreign entities. They're not even going to American financial
Really?
firms. They're going to foreign banks. So you consider the fact that, again, you're talking about hundreds of millions of dollars here between reverse repos and interest on reserves. Now, we don't know quite how much of the interest on reserves are going to foreign institutions, because you have direct payments, you have indirect payments. There it gets a little complicated, but for reverse repos, it's very clear how much of that is foreign. Again, it's over 2/3. So a pretty substantial chunk of what we're talking about here in terms of those daily interest payments aren't even staying here at home. They're going overseas. And all of this, at the end of the day, when you consider that it's costing American taxpayers,
Yeah.
because Fed costs ultimately eat into Fed profits, and Fed profits are typically given over to the Treasury. That means that every time you increase costs at the Fed, I don't care if it's renovations or if it's these interest payments, you're
Yeah.
talking at the end of the day about a cost to taxpayers.
Yeah. And I think, honestly, I said this yesterday, actually, on an interview with News Nation. The lack of respect that Jerome Powell has for the U.S. taxpayer is blatantly obvious.
Mm-hmm,
And it's
mm-hmm.
something that I wish he would correct. I think if Jerome Powell, in a very, very succinct comment by me, if he could gain a little bit more respect for his mandate and for the taxpayer, I think he'd be doing a much better job. But he's lost sight of both of those. I want to go back to
Exactly. You're absolutely right. It's that mission creep, right, that the Treasury Secretary talks about, and actually that you've talked about as well. I think you mentioned it in a Newsmax interview you had the other day, where the Fed for years now has been focusing on things like I don't care if it's the renovations or if it's ESG or DEI or all this other garbage, trying to regulate banks into making loans for green energy firms
yeah,
and other nonsense that literally loses money. But the bank has to make this bad loan that it knows will go bad just so
yeah.
that it can get a better score when it comes time for the Fed to do a stress test. I mean, this is completely taking your eye off the prize. Whatever happened to price stability? Because clearly the Fed wasn't focused on that for the last 5 years.
Absolutely.
Back off some of the earlier criticism?
Well, I'd love him to lower interest rates. But other than that, what can I tell you? The country is doing really well. I just briefed the chairman of the deal with Japan. Japan is putting up $550 billion in order to lower their tariffs a little bit. That way they have a little bit lower tariff. And they also opened their country to free trade, which nobody thought was even a possibility. And
That looks so miserable.
we get a zero tariff in the free trade. We don't pay tariffs, and they're going to pay 15% on everything they send into our country. So it's great. But they put up, as you could call it, seed money. Let's call it seed money. You could call it anything you want, but it's
The whole idea of him heading over to the Fed, honestly, was, for me, it was kind of like, wait till your father gets home. Like, you're a little guy. I mean, I had a lot of those episodes as a little guy. Mom's had enough. She says, go to your room and wait till your father gets home. And then you're sitting in there trying to figure out, like, how bad this is actually going to get.
Yep. Yep.
I think that was Jerome for the day, waiting for the afternoon visit. And I say this without kidding around, don't think there was no strategy to the icing of Jerome Powell for the entire day, waiting to go in the afternoon rather than going at 8 or 9 in the morning, because Trump is sleeping 2 hours a night anyway, because that's all he needs. It was an icing of Jerome to kind of wait for Daddy to get home at 4 or 5 o'clock Eastern time to see what was going on at the Fed. I want to bring up, before we go to the remittance payments to Treasury, which is the chart is ridiculous. It's shocking. I want to go back to something you said, because this is really important. The mismanagement of monetary policy and balance sheet by Powell it's fact. It's not opinion. It's been a disaster.
Mm-hmm,
The promise of lower forever, and then the spiking of rates heading through 2021 into 22, and the creation of, arguably, he created the regional banking crisis at that time and spun banks like SVB out, basically because of what you said, right? They had assets on the books at where they were receiving very low interest on. They were guaranteed by the Fed implicitly that there would be lower forever. all of a sudden rates spike, and now what they're being paid on assets is at 2%. What they owe out on liabilities becomes 5%. It breaks. The model breaks, right? So you have a bank like SVB. If there's leverage on the balance sheet, then and enough leverage, they can't handle that break. They can't handle that spread. It's and I'm saying that in a simplified way, but that's essentially what happened to, let's just say, Silicon Valley Bank, right? At the hands of the Fed policy.
Exactly.
So what's crazy to me is not only did he do that to Silicon Valley Bank and create stress on the regional banking system, he's done it to himself at the Fed. He literally has stepped in the same bear trap. He set the trap and then stepped into it. And he's trying to make an argument that he's competent at his job. I mean, for me, in this conversation, that's the best way I can put this. You literally laid the trap down, went and got some s'mores at the bonfire, and then walked back into the bear trap you just put down. And you're looking around saying, stop picking on me. I should be independent. It's insane to me that you could be, I don't want to be insulting. I really don't, because it's not in my nature, but that's, I don't have another word aside from really incompetent.
Yeah, exactly, Anthony. That's spot on. Everything you just said there, 100% right. He is grossly incompetent at his job. And look, even when you have an economist in the role of Fed chairman, they typically don't even do that well. Okay, because very oftentimes they're just not good economists. But he's not even an economist. He's an attorney by trade. He has no training to prepare him for this role, and it shows. He has made mistake after mistake, and it wasn't simply just it's not just right now what he's doing with rates. It's not just what he did under Biden with the balance sheet and with rates and with these other crazy policies like interest on reserves. This all goes back to even the first Trump administration, when he was operating under this ridiculous notion that somehow because Trump was delivering faster economic growth, that was going to magically cause inflation. I'm sorry. Inflation is supposed to be too much money chasing too few goods. And faster economic growth is exactly the opposite. It increases the amount of goods relative to the amount of money, right? So that actually puts downward pressure on inflation, not upward pressure. And he responded by increasing interest rates and selling off the balance sheet. And he over-tightened monetary policy so much that by September of 2019, the Fed actually briefly lost control of interest rates, and it caused this basically collapse of a lot of leveraged hedge funds. And he then had to turn around and do a bailout of those hedge funds, and it cost $500 billion. It was $500 billion. And that was still ongoing in the second week, really, of March 2020. But everyone forgets about it because March 2020 was when the economy shut down from COVID, and the Fed went on its everything bubble buying spree. And that kind of took over Americans' collective consciousness at that point. But again, the fact remains that his entire tenure as Fed chairman has just been a string of mistakes, one after the other after the other. This is not a recent phenomenon.
Yeah, it's amazing. So if we look at, that's an awesome point, and it's actually an awesome point on the bailout of the hedge funds heading into COVID. This stuff kind of gets swept away, but I continue to say, and part of my criticism for Powell is really the fact that I believe a lot of his decisions and poor decisions were political. And that is a real problem. So people want to criticize Trump for not allowing the Fed to be independent. I would argue Trump is criticizing the Fed because it's not independent. Right. That would be my argument.
Yeah, exactly. That is spot on, Anthony. I think that take is exactly correct to yours.
I say I flip you. I flip that for real. Anyway, a little reference to the usual suspects. So if we go back to, I can't do the Trump impersonation like you, but I can reference solid early 90s movies. If we go back to the remittance payments to the Treasury, you and I started talking about this a while ago. I didn't realize that the Fed actually paid the Treasury or handed over remittance payments to the Treasury on the profits they made on the balance sheet. You can see from the red line that just imagine this as your P&L. That's not a good red line. So if you're at the Treasury expecting incoming payments, they've fallen off quite a bit. what's the effect here? So they're losing money. They can't make remittance payments. What's the big deal?
Well, in terms of the effect on the Treasury, as you said, the Fed normally turns a small profit, relatively small, right, and then it hands that over to the Treasury. That's part of the Fed's charter. It doesn't get to keep that money. So the Fed makes money. It then essentially uses that to pay for all of its operating expenses, and then hands the rest over to, in this case, it should be Secretary Scott Bessent. But that's not happening anymore. It hasn't happened since September of 2022, because every week, instead of making money, the Fed has actually been losing money. They just lost hundreds of millions of dollars last week because of the things we were talking about earlier in this episode. And so you're at a point now where the Fed has lost over 236 billion with a B dollars. Now, we should point out, though, that the cost to taxpayers has actually been even more than that, because as you can see on this red line, it looks almost like a seismograph where there's not a lot of activity, right? Where it's bouncing up and down for literally years here until you get to the fall of 2022. And the reason for that is because the Fed will make money for a little bit of time, but then it has to hand that money back over to the Treasury. So the balance here goes down to zero. So it keeps going up from zero and then back down, going up from zero and back down. So all of those weekly profits have just been replaced by ongoing losses. So you have to keep in mind that not only is there this cumulative loss, that means we have that loss essentially, but on top of that, it's also weekly profits that should have been happening in place of the loss. So let's just use some random numbers to kind of illustrate the point here. Let's say the Fed has losses of $100 million 1 week. Well, it ordinarily would have had profits of $10 million. So the cost to taxpayers really isn't the 100 million, it's the 110. Because what's going to happen now is the Fed is not only going to have to stop losing money, but it's going to have to make money to make up for all of these losses. These losses actually go on the books as a deferred asset, it's called. Yeah. Only the Fed, right? Only the Fed gets to put losses on the book as an asset, but that's what it does. So the Fed now is going to have to stop losing money and start making money. It essentially pays itself back to get rid of this deferred asset, to get that off the books, before the Treasury will ever get another dime. And so again, you got to look at this in terms of not only the losses, but the revenue that would have ordinarily been going to the Treasury. So you add that up, and at this point, it's not 236 billion, it's over 250 billion, $250 billion that should have gone to the Treasury. And again, if the Treasury loses receipts, money that should be coming in, whether it's income taxes, whether it's remittances, whatever, that's a direct cost to taxpayers, because that money needs to be made up. That lost revenue needs to be made up somewhere else. And that's exactly what has been happening. And so this has actually contributed to the deficit, and it's going to continue contributing to the deficit for years to come.
It's insane. It really is insane. When you talk about the mismanagement, it starts to become almost just a political conversation, right? Like I'm a Democrat, I'm on the left, I support Powell. I'm a conservative, I'm on the right, I support Trump. But there's a lot to this. I mean, this has really been a massive mismanagement. If you start to look at, and we started the podcast, the episode today, talking about this is fact. These are facts. This is not a biased number. This is not a biased chart. These are facts. These are numbers, and they mean something. There's a real, again, a lack of respect for the mandate, and a lack of respect for the U.S. taxpayer is a real thing. If we look at reserve balances at the Fed, just to see kind of on this balance sheet issue, you put up a great chart in billions of dollars. The reserve balances at the Fed now, or those are the balances that the Fed is actually holding from banks. You had said earlier, a large portion of them foreign banks that the Fed is now paying interest out on at a higher rate than they receive interest on the assets they own. Is that correct?
Exactly. That's that interest rate mismatch that we talked about earlier. And you can see here, they've gone to this frankly stupid ample reserve policy, or whatever they want to call it, or excess reserve policy. And look where we were, right before COVID, where you're a little over 1,600 billion. Now, where are we today? well over 3,200 billion. We've doubled. We've doubled reserves. And the insane thing was, from back then, we were only paying interest on excess reserves, quote unquote. In other words, what banks had in the Fed above the reserve ratio. In other words, the reserve requirement, where banks had to keep, whether it's 10%, whether it's 20%, the percentage has varied over time, how much banks have to keep at the Fed. But there was a fixed amount. You didn't get paid interest on it. You just had to have that holding. You just had to hold that in reserve at the Fed, if and when some kind of emergency finally arose, which of course they always do because of fractional reserve banking. Today, they got, or I should say back in March of 2020, they got rid of that entirely. There is no reserve requirement anymore. Banks literally can loan out every single cent of every dollar that gets put on deposit. The only reason they don't is because the Fed pays them interest not to. And this is part of what is now actually driving up Treasury yields today. Originally, this was done to kind of try to keep Treasury yields down, but it's having the opposite effect now, because every time Treasury holds an auction, right, they have to offer a high enough yield to attract people to the auction to buy all of the bonds, notes, or bills, whatever Besant is auctioning off. Well, money is now being kept on the sidelines, which means it's not available for lending, including to the Treasury. So here you have $3.2 trillion, 3,200 billion that is being kept on the sidelines, that is not available to be lent to the Treasury. And so as you increase the scarcity by reducing the supply of loanable funds, you're putting upward pressure on yields. And that's exactly what we're seeing today. A very easy way to get help get Treasury yields down, which is what Besant wants, which is what Trump wants. That's why they're hammering for a cut in interest rates. An easy way to get the yields down would be to simply tell banks, we're not paying you interest on your on your reserves anymore. You have to keep 10%, 20%, whatever it is, on reserve at the Fed, but the rest, we're not paying you a dime on any of it. Yeah. And what that would do is instantly stop the competition, which is what we have right now. It would stop the competition between the Fed and the Treasury. Think of that. Powell has created this bizarre situation where banks have to choose, do I want to lend to the Fed, which is what you're doing essentially when you keep money parked there, you're lending to the Fed. Do I want to lend to the Fed, or do I want to lend to the Treasury? And what I think the mistake a lot of analysts have made here, Anthony, when they say, oh no, they dismiss it. They say that's not a concern. The Treasury is offering 5% and Powell is offering 4 point whatever. There's no competition there. I would just lend to the Treasury. No, you won't, because when you lend to the Treasury, you're buying a bond for 20 or 30 years and you're locking that in. When you lend to the Fed, you can do it on a daily basis. Yep. So there's no liquidity premium or there's no term premium, right, attached to it. So that's why it becomes a no-brainer for a lot of banks to just lend to the Fed, again, instead of lending to the Treasury. And it is now, going back to what you said with costing the taxpayer and how there's no respect for that. Yeah. This is increasing interest on the debt, which is, again, a cost borne by taxpayers. Yeah. Yeah. And so these insane policies at the Fed are ultimately being paid for by us.
Yep. Paid for by us. And they are counter to, they're so counterintuitive. They're literally, they're hurting the taxpayer in every way. And they're not, the Fed being independent doesn't mean that the Fed should not be running policy in a way that's in line with the administration's view or overall strategy for the U.S. and for the economy. Those are two different things. So I think this is another great example. And honestly, this is a fantastic example. No one is talking about this at all. You are, but it's a great illustration and a great example of how another way that Jerome Powell is just completely mismanaging the Fed and his position there. Again, wait till Daddy gets home. Last chart of the day, and this has been phenomenal because this has all been your work. And it's all been very enlightening. I love going through this with you because I always get educated. The M2 money supply, all-time highs.
Yeah. And you could see there, basically when the balance sheet runoff finally starts belatedly, M2 starts to come down and interest rates are going up, also helping to bring M2 down. But then it bottoms in 23, and it just starts right back up again. And all these people who were panicking about, oh, there's going to be deflation. Oh, dear goodness. The economy never even caught up to the increase in M2 before M2 actually started increasing again, which again was well over a year ago. Well, at this point, 2 years ago. And it's been on a steady upward trend. And you can see now in recent months, it's actually rising at a faster rate than it was during that pre-pandemic period, which is where you get that linear trend line you see on the graph, the dotted line. That's basically taking the period from the end of the Great Recession until the explosion at the start of COVID. So it's that whole period of expansion. So it's June of 2009, I believe, is when we date the end of the recession, all the way until probably February of 22. It is seasonally adjusted, yes. So it's those months. What we're basically seeing from the Fed, because the Fed can control this, is they're allowing M2 to grow too fast again. In other words, they're putting, despite the high interest rates, despite the running off of the balance sheet in very slow runoff, they're still allowing M2 to grow too quickly, which means inflationary pressure in the real economy. Part of that is to accommodate congressional spending. But as long as you have this kind of bad action on the part of the Fed, and as long as you have continued overspending by Congress, President Trump's going to have his hands tied a little bit. I'm increasingly getting worried about what the inflation numbers are going to look like later this year, because even though the president's doing great work in terms of shepherding the tax bill through Congress, he got that done. He's doing phenomenal work on the deregulation front. He has every department, every agency of government going full throttle on that. Those are all things that are going to help bring down prices in the real economy, bring down consumer prices. But that's kind of at loggerheads right now with Fed policy, that although it may seem on the surface like it's overly tight, you dive into some of this stuff and it actually looks like it's getting looser, not tighter.
Yeah.
And it's particularly concerning too when we look at the amount of leverage, Anthony, that the Fed is allowing in this economy. Again, some of this goes back to what they've done with things like reserve requirements and what they have failed to do on the regulatory front, where they've been so hyper-focused on things like how much green energy do you have in terms of your loan portfolio, Wells Fargo or Bank of America? Oh yeah, because that's a great indicator of the health of a bank. But they've done garbage like that instead of looking at the actual quality of loans, instead of looking at the actual, the actual, I don't want to say threat of liabilities, but what are the kinds of liabilities that you have on your balance sheet? Do they have call options, for example? It really is amazing how, as the Fed has taken its eye off the prize of price stability, which frankly it was never that good at achieving in the first place, but as it has taken its eye off that prize, it's just gotten even worse.
This has been an amazing education, honestly. Repos, reserves, and remittances, I think, is a good way to recap what we've talked about, and just complete mismanagement. Their eye is definitely off the prize. EJ, thank you so much. This has been a great episode for me in particular. It's been a great education as always, but to really dig into, we say mismanagement of policy, monetary policy, we say mismanagement of the balance sheet, but it is pretty deep. It's pretty heavy stuff. You do a great job of breaking it down and actually explaining just how many mistakes are being made there, and then what the risks of those mistakes are for the U.S., for our economy, and for the tax dollar. EJ, as always, thank you so much. Great episode. Fantastic job. A true education.
Hey, Anthony, it's always my pleasure to be with you, man.
Thank you, man. I appreciate it. Have a great weekend, and look forward to seeing you next week.
Until next time.